real participants are professionals. I mean, yes, there's a lot of silver stackers and these rule changes in the Chinese market. And I made friends with Eric Young. There will be some changes in COMEX. That's a gut feeling. I don't have any inside information. These position limits that do exist may start to be enforced, especially with China taking. And the exchange itself is going to say, wait a minute, boy. Mike Doran's on the silver too yesterday. I'm going to see if there's a big increase or a notable increase in recycling. I'm going to look at sentiment. I think a lot of it's been punched out in this January pullback. I'm going to look for how quickly we go up to 100. So if it's a matter of stabilizing around a trading range of, say, 85 to 75 for a matter of 3 weeks, and then, a month and a half from now, we're back up near the high 90s, that just proves how much physical demand there is and how strong this market is. And that's kind of what I expect. I'm looking for the gold-silver ratio. If we get to a 30-to-1 gold-silver ratio, which is roughly double where we are now, meaning silver's outperforming gold 2-to-1 from this point forward, I'd start looking at taking some profits off the table. Could it get beyond that? Yes. Could it go below that? Yes.
And if enforcement tightens on February 28th, what happens to an oversized short position on March 1st? In 2011, rules tightened caused liquidation. It didn't cause a squeeze. Why wouldn't this produce similar downward pressure?
I think it would. But markets look ahead, as we both know. The stock market sees into the future. So does the metals markets. Gold is the best barometer out there for the general world economy, in my view, and I've studied this market for a long time. So I think that'll kind of find its way before we actually get to March 1st. But yeah, it's more downward pressure. Most of the public goes long. Most of the trading funds, the CMTs, you put your money into an account for the futures broker to trade for you. Those funds are limited on cash, like I said earlier. So they've only got so much devoted to silver, which pales in comparison to what they have in oil and gold. So it's really a thin market. So we'll weed it out. And again, I would love to see the position, excuse me, Jeremy. I would love to see the position limits upheld in the COMEX. Really, there's supposed to be mitigation of that, just like what Shanghai is doing in the COMEX. You aren't supposed to have these extremely large positions that are backed by nothing more than a piece. But yet the exchange seems to look the other way.
Yeah.
Policy enforcement rarely causes squeezes. It usually exposes who was over-leveraged first. As David Morgan suggests here, thin liquidity in silver futures means regulatory tightening can trigger liquidation instead of rallies. In 2011, when COMEX margin requirements rose 5 times in 9 days, silver collapsed nearly 30%, showing how leverage unwinds overpower bullish narratives. David Morgan is indirectly pointing to structural fragility. Funds allocate far more capital to oil and gold futures, leaving silver vulnerable to sudden volatility. For investors, this signals liquidity risk, not just price risk. Next, David Morgan explains why industrial buyers care more about ounces than price headlines.
And for the people that are just watching at home and they've been watching this AI guy and everything else, let's get to the bottom line for that viewer. If March 1st arrives and the world hasn't changed, does the regulatory squeeze kind of thesis lose all credibility?
I don't think so. I think it, because the real participants are professionals. Yes, there's a lot of silver stackers and there's an industry that needs it. And the industry doesn't really, they care about the price, but these days they care more about ounces. How many ounces do I need over the next 2 years to keep Samsung viable? How much does Tesla need over the next 2 years to run all the, manufacturing that Tesla does with silver? So I think they're more concerned about what is the flow rate, what is the amount of silver that's actually readily available physically, rather than, how far is the market moving or what are the rules. Having said that, I think it will tone down the market, maybe calm it down. I still expect higher prices. I don't think the top is in.
The real silver story isn't speculation. It's supply security. As David Morgan highlights, industrial demand from companies like Samsung and Tesla depends on physical availability, not daily price swings. The Silver Institute reported industrial silver demand hitting record highs in 2024, accounting for over 55% of global consumption, driven largely by electronics and solar manufacturing. David Morgan is pointing to a shift where procurement managers prioritize long-term supply contracts over short-term price volatility. For investors, that means fundamentals may support prices even when speculative momentum fades. Next, David Morgan discusses why bull markets often accelerate late in the cycle.
I think we're in the final phase. I've talked about 90% of the move coming in the last 10% of the time. We are there. How much longer do we have to go? I don't think very long. I think we could see the ultimate peak in gold and silver in the next year or two. There's many that disagree with me, and that's fine. And I'm not saying I'm right. I'm saying how markets move, what I've studied, and what I think.
I wanted to ask you, at what prices does that start to matter? Because no industrial buyer is completely price insensitive. And we're seeing these huge prices. I mean, once it went over 100, are we talking about short-term procurement at any cost, or do you think long-term contracts where price absolute, matters?
Well, it always matters at some point, as you said.
Yeah.
For a lot of applications, it's inconsequential. It's already hitting the solar industry. I just did my mastermind with Mike Lorenzo yesterday, and he said that on rule of thumb, the general market is silver's 40% of the solar panels now. Well, that's significant. So they're looking for alternatives, copper, graphene, or maybe, making mitigations. There really aren't any substitutions now. But the point is, I think the markets really are efficient over time.
Late cycle commodity rallies often feel unstoppable right before demand adapts. As David Morgan notes, the 90% of gains in the final 10% of time pattern mirrors past commodity spikes like silver in 1980 and 2011. Solar manufacturing now consumes massive amounts of silver. Estimates suggest photovoltaic demand alone exceeded 190 million ounces in 2024, tightening supply conditions. David Morgan is also acknowledging the risk investors ignore. High prices accelerate substitution research, just like fiber optics reduced copper demand growth in the early 2000s. Markets rarely stay inefficient once industry margins get squeezed. Next, David Morgan explains why ratios matter more than headlines.
They're inefficient at times. That's why we invest. This is undervalued. I'm going to buy it. Oh, it's overvalued. I'm going to sell it. But right now, the efficiency in the silver market remains to be determined. But as we get more and more toward a cash-only market, which I don't think we'll ever go to, I'm not sure it's the best. I think we do need to be able to hedge. When we get, let's say, the rules in place that it's more realistic as far as how much can be hedged versus how much is produced, we get into that kind of balance, I think you're going to see a much more stable market, and I think you're going to see less, violence. But I think we're going to be quite violent. So last comment on your question, I'm looking for the gold-silver ratio. That's really the only way not the only, but one of the best ways to determine silver being overvalued or undervalued. If we get to a 30-to-1 gold-silver ratio, which is roughly double where we are now, meaning silver's outperforming gold 2-to-1 from this point forward, I'd start looking at taking some profits off the table. Could it get beyond that? Yes.
Ratios quietly reveal extremes long before prices do. As David Morgan explains, the gold-silver ratio has historically signaled cycle peaks, falling near 30-to-1 during strong silver bull markets like 1980. The ratio averaged around 65-to-1 over the past 3 decades, showing how unusual extreme compressions can be. David Morgan is essentially describing a portfolio timing tool rather than a price prediction model, something many investors misunderstand when chasing commodity momentum. For diversified portfolios, ratio compression often signals rotation opportunities rather than simple buy more silver decisions. Next, David Morgan explores how far ratio compression could realistically go.
Could it get to the classical monetary ratio of 15, 16-to-1? It could. Could it go below that? Yes. But I don't think it's going to go much below 30-to-1. But time will tell. But that's when I know that the physical market or the silver market is at a level that we should really consider enough's enough and taking at least partial profits.
Yeah, that's interesting because, the ratio compresses late in precious metals bull cycles. Historically, I mean, if we're in that phase, what do you kind of look at?
Well, the acceleration, which you talked about a couple times, and also, if there's congestion in the physical side, will keep the market moving higher, which we are seeing. So that's why I remain bullish, and I still think the top isn't in. But there could be a time where, the industry's satisfied. They've got 2 years supply in the warehouse. Oh, graphene can work in solar panels now, and it is economic. So, those possibilities do exist. No market grows to the moon, even the silver market. So you want to be a little bit careful.
Extreme ratio compression often signals risk, not opportunity. As David Morgan points out here, late cycle metals rallies historically compress the gold-silver ratio before momentum fades. Exactly what happened in 1980 when the ratio briefly fell near 17-1. Industrial inventory buildup can quietly cap prices. If manufacturers accumulate even 12 to 24 months of supply, demand urgency disappears quickly. David Morgan is hinting at something investors miss. Physical congestion often appears right before commodity tops, not during shortages. For portfolio strategy, acceleration without new demand drivers usually signals a maturing cycle. Next, David Morgan explains how ratios can guide asset swaps between metals.
I want to be a little circumspect that this is a market to, hedge the fiat currency fiasco and everything else that I've taught for the last 40 years. But it doesn't mean that the market won't change at some point. So you have to be aware of that.
Yeah. I mean, is the ratio now, I guess, a timing tool, or do you think it's just a long-term rebalancing guide? Because, most people misuse it.
Well, I use it, and I think it's very useful if you look at the extremes. When I wrote the January issue last year, gold had already made a substantial move, but silver and platinum hadn't moved. I said, if you're a new member, please buy silver or platinum or both. If you're a long-term subscriber, consider swapping some gold for platinum. And once ink dried on that issue, platinum and silver both took off and both outperformed gold year over year, which was surprising because gold had already made a huge move. And I just felt the best value was in those two metals. And just to comment on it a little bit further, using the ratios and how they work for you. If you do a silver platinum ratio, which hardly anyone looks at, I'm looking at the goofballs it does, you will see that silver platinum ratio, platinum is at a 25-year low relative to what it costs in terms of silver. So if you wanted to swap your silver for platinum, you're buying it at a 25-year low, moving your silver into platinum. That's something to think about.
Investors chase momentum while value quietly rotates elsewhere. As David Morgan explains, ratio analysis can reveal undervalued assets even when headline metals are rallying. Platinum traded near multi-decade relative lows versus silver in 2025, reflecting weak auto catalyst demand and investor neglect despite tightening mine supply in South Africa. David Morgan is describing classic rotation strategy, selling strength to buy neglected assets, something institutional commodity funds do routinely. For long-term investors, diversification inside the metals complex can reduce volatility while maintaining inflation hedge exposure. Next, David Morgan reflects on how unexpected silver volatility caught even seasoned analysts off guard.
These latest swings, you've been doing this a long time, David. I mean, when you see gold shooting up past 5,000, 55, we saw silver do that little top-heavy dance. I mean, how fast that went, did it surprise you this year?
So first of all, 2025 surprised me. I mean, I did call, like I said, hey, it's time to get into silver if you're not. But the 140%, that surprised me. January definitely surprised me. I wasn't all that happy, even though, my personal portfolio is looking pretty good day by day. But I go, this can't last forever. And if this thing goes all the way up to 200, for example, that could be. Didn't. It stalled out at 124 or something like that. So I think we need to, take a deep breath and let the markets work the way they're supposed to. And I kind of missed your question. You want to give it to me again? Sorry, Joe.
Well, I'll give it to you in a different way. I mean, there's this strong narrative that AI and solar demand will overwhelm supply, right? I mean, at the same time, engineering innovation reduces silver content per unit almost every single year. You pay attention to this. Is industrial demand compounding or does that high price accelerate substitution and kind of cap that long-term upside?
Yeah, I think it will. I mean, everyone's a big believer in technology. I am as well.
Even bullish experts get nervous when markets rise too fast. As David Morgan admits, a 140% silver surge in a single year resembles speculative blow-off phases seen in commodities before corrections. Rapid price spikes often attract momentum traders rather than long-term industrial buyers, creating unstable demand foundations. David Morgan is also acknowledging a hidden force. Engineering efficiency steadily reduces silver usage per device, especially in electronics and solar cells. For investors, technology improvements can quietly offset demand growth even when headlines scream shortage. Next, David Morgan looks back at how technology once reshaped silver supply expectations.
I don't think it's a panacea. It's going to solve all our problems.
Yeah.
We go back to my predecessor he predicted silver would be $200 the ounce in 1990 or mid 90s. He wrote the last book around 1980. And his basics were right because at that time we were only mining 350 million ounces of silver on an annual basis and had been that way for 60 years. So we had 60 years of data. But once the ink dried on that last book where he made that wild prediction, because silver was, I forget, the teens, I think, that there was a new technology. And the new technology brought more silver and gold to the surface economically. And we started increasing production like crazy. So his supply demand was off. The supply increased dramatically. Will that happen in the silver market? I doubt it. There aren't that many big viable projects in silver. I know a few, I write about them, but I think it could be substitution of some type. I mean, the graphene thing has been talked about. Again, I talked to the Silver Institute. Mike said that, it's a ways off. But, markets are pretty efficient in the long run. And if you need to substitute silver for solar, and you can wrap copper with another element, I don't know. And it costs less. Definitely do it.
Commodity forecasts fail most often when technology changes supply curves. As David Morgan recalls, silver production expanded dramatically after new extraction technologies emerged in the 1980s and 1990s, invalidating long-term scarcity predictions. Global silver mine output now exceeds 800 million ounces annually, more than double the levels from that earlier era. David Morgan is reminding investors that supply shocks often come from innovation, not new discoveries, a pattern seen in US shale oil after 2010. For long-term portfolios, technological disruption remains one of the biggest blind spots in commodity investing. Next, David Morgan discusses the real signals he watches to confirm demand strength.
I mean, things get better and better over time, generally speaking. I'm not talking about societal moral structure. I'm talking about efficiencies in the market stuff, marketplace, the stuff we buy.
You're looking ahead at the rest of the year, which I know you do. I mean, the strongest signals we're watching are real verifiable data points, the duration of the Shanghai premium, movements in registered versus eligible, flows into physical and out of ETFs. Talk to me a little bit about what you're watching closely and give me your outlook for gold and silver this year.
Well, I'm looking at, these rule changes in the Chinese market. I made friends with Eric Young, who seems to have a very good handle on what's going on in China. He lives in Hong Kong, and I've interviewed him personally once or twice. I listened to most of his interviews. I also think that there will be some changes in the COMEX. That's a gut feeling. I don't have any inside information, but I have a feeling that these position limits that do exist may start to be enforced, especially with China taking the lead. I think there may be something. And the exchange itself is going to say, wait a minute, boys.
When exchanges start talking about position limits, it's rarely random. As David Morgan notes, watching Shanghai premiums and ETF outflows gives cleaner signals than social media noise, especially when Chinese demand diverges from COMEX pricing. Persistent Shanghai premiums above $20 to $30 an ounce have historically signaled tight physical markets, not paper speculation. David Morgan is hinting that enforcement of position limits could restrain oversized speculative shorts, something critics have flagged for years. For investors, structural rule changes matter more than daily price swings. Next, David Morgan addresses what happens when inflation psychology turns disorderly.
We've been kind of turning our heads on this, this part of the contract or the limits, and maybe we should relook at that. So we'll have to see. I would like to see a more orderly market, but that's not what the metals portend. Metals portend at the end of the great inflations, violent moves to catch up with the misallocation of capital and the happy spending that the governments have done worldwide, and they pay catch-up mode. And that usually happens in a big hurry, and that's what we're witnessing now.
And I mean, you and I were chatting a little bit about this. There's a lot of rumor, speculation. There's headline fear out there right now, especially on social media. But rumors don't move markets. Verified data does, which you and I try and watch. So, I mean, what's your tips for people that are late on this train? They haven't been covering these markets for years. They've just jumped on. I mean, what's your advice for those that just, there's so much out there?
It's a tough one. I don't like to see people lose money, but I really think if we do go into a hyperinflationary blow off, which I doubt, but a inflationary spell that really worries people, I think everyone needs some metal.
Violent metal moves usually reflect years of policy excess, not overnight panic. As David Morgan explains, inflationary catch-up phases historically follow prolonged fiscal expansion. US federal debt has surged past $34 trillion, a backdrop that fuels hard asset narratives. Yet David Morgan also cautions that verified data, not rumor cycles, should guide positioning, especially during volatile periods. Hyperinflation is rare in developed economies. Deflationary shocks, like 2008, often hit first and punish leverage speculators. For late entrants, measured allocation matters more than emotional chasing. Next, David Morgan outlines how much exposure is actually enough for protection.
And how much is enough? And the answer is it varies from person to person. But you don't need to be overly exposed, that's for sure. So, I mean, if you're not exposed to the metals, you can do it. And I think physical is the best way to do it. And in that case, maybe what you're taught by a certified financial planner. Well, what do you need? When you're starting out or even when you're middle-aged, the suggestion is 2 or 3 months worth of pure cash in the bank. Well, pure cash in the bank to me is physical gold and silver. So if your expense rate is $4,000 a month, 3 months is 12 grand, 12 grand in silver and gold, that's probably enough for almost everybody. Yeah, and if there's a crisis, then that value of that might stay at 12,000 price wise, but the value may actually go up. In other words, if the housing market's cut in half, the stock market's cut in half, even though gold and silver prices remain constant, I'm not saying they would, but as a thought experiment, then you've actually doubled your value because you could buy twice the amount of housing or twice the amount of whatever. So I would go into that. And what I think is so interesting, Jeremy, is this.
Metals as liquidity insurance, not lottery tickets. As David Morgan frames it, holding 2 to 3 months of expenses in physical metals mirrors traditional emergency fund logic, just denominated differently. During the 2008 crisis, the S&P 500 fell roughly 57% peak to trough, while gold held value and later advanced, preserving purchasing power. David Morgan is emphasizing relative value. If asset prices collapse while metals stay flat, your buying power effectively increases. For disciplined investors, this is about resilience, not speculation. Next, David Morgan reacts to institutions quietly shifting portfolio allocations.
People that used to make fun of people like me are now in the mainstream talking about debasement trade. Well, that's why you're in this trade from the beginning. And I used that word 25 years ago. But secondly, and more importantly, there's giving suggestions of like a 60-20-20 portfolio. Are you kidding me? I've recommended 10, maybe 20 at the most. But stalwarts saying 60% bonds, 20% stocks, and 20% gold from notables on Wall Street. And that's very interesting to me because the institutions start following into gold, and I believe that they will. Then I don't think again the top is in. I think we could see this 5,000 may be a pit stop on the way to 10,000. I don't know, but there's a lot of demand for gold as this debasement trade gets near the end, which means trust in the overall system degrades to a point where people just don't know what to do with their money, and they don't want to put it into dollars. They don't want to put it into treasuries, short-term, medium-term, or long-term. And when the trust gets to that level, and hopefully it won't, but if it does, we'll probably have a new paradigm.
When Wall Street embraces gold, it's usually late cycle, not early. As David Morgan observes, institutional voices now floating 20% gold allocations mark a dramatic shift from the classic 60-40 model that dominated for decades. Central banks purchased over 1,000 tons of gold in both 2022 and 2023, signaling sovereign-level diversification away from dollar reserves. David Morgan is right to question timing. When consensus pivots, upside can continue, but volatility increases sharply. For investors, trust erosion narratives can drive flows faster than fundamentals. Next, David Morgan's outlook hinges on whether confidence in treasuries truly fractures.
What are your advice to those new investors?
Well, I'm going to be looking for what I talked to Mike Dorenz on the Solar Suit yesterday. I'm going to see if there's a big increase or a notable increase in recycling. I'm going to look at sentiment. I think a lot of it's been punched out in this January pullback. I'm going to look for how quickly we go up to 100 again. So if it's a matter of stabilizing around a trading range of, say, 85 to 75 for a matter of 3 weeks, and then, a month and a half from now, we're back up near the high 90s, that just proves how much physical demand there is and how strong this market is. And that's kind of what I expect. I don't expect another 6 months for a trading range. I think there will be one, but I don't think it's going to be very long. So we really are in the final phase from everything I've learned over the last 40 years of studying markets. That's markets, not just the metals markets. And this means that if you're not on board now, don't be afraid, but don't overdo it. You don't need a lot of, gold exposure to have a hedge.
Short-term price stabilization often reveals more than dramatic rallies. As David Morgan suggests, recycling flows and sentiment resets are key indicators of whether demand is structural or speculative. After silver's sharp January correction, stabilization between 75 Wasserturm and 85 Dollar would resemble consolidation phases seen in 2010 before silver's final push higher. David Morgan is essentially watching whether physical demand absorbs supply quickly, a sign institutions and industry buyers remain active. For investors, consolidation strength matters more than price spikes when evaluating cycle maturity. Next, David Morgan explains why metals should be treated more like insurance than speculation.
Again, it's something that we really don't want to have to use in a way. I mean, if you want to look at it from an investment and an insurance policy methodology, that's fine. You can do both. But if you just look purely at, an insurance position against whatever else you own, real estate, stocks, bonds, what have you, then I think a modest position is fine. And no one cries about paying their fire insurance on their house every year because their house didn't burn down. It's a price you pay for stability and insurance that, if something really goes wrong, you're covered. And I think that's the way to approach the market at this point in time for most people.
The real value of metals appears when everything else fails simultaneously. As David Morgan emphasizes, treating gold and silver like insurance reframes expectations away from constant returns toward portfolio resilience. During the 2020 pandemic crash, equities fell over 30% in weeks, while gold recovered quickly and reached new highs by August 2020. David Morgan is reinforcing allocation discipline. Modest exposure can stabilize portfolios without sacrificing growth from equities or real estate. Investors often underestimate psychological comfort during volatility.